Well, good evening, everybody, and welcome to the Wood Centre for this second in the Exit Right series of events that's been organised. I think for those that were here last time or participated online last time or caught up on YouTube or wherever this is available, I think you would have found the last set of speakers very, very interesting and having a very interesting story to tell about how they went from a very, very small opportunity to begin with to a pretty impressive exit after quite a short period of time. I wish everyone could achieve that, but there was certainly some good lessons to learn there. Tonight we have two more speakers to tell their stories about how they've gone to their journey to an exit of kind of very different kinds, actually. So we're going to have Matthew Walls. He's unfortunately running a bit late, but he will join us shortly, and he's got an interesting story to tell, which ultimately led in an AIM listing, and that was a couple of years ago, so he's probably got some things to say about how it's been going since then as well. But to kick us off tonight, we've got Andrew Lewers of Habitat Energy to tell us his story of that business's journey to its exit, which was an acquisition, I believe, which I'm sure he'll explain more about. The technology, I think, behind Habitat Energy is interesting and quite difficult to get your head around, I guess. But I'm hoping Andrew's going to explain a little bit about that as well for those that want to know about that too. So the plan is to run this session for 45 minutes. Then we'll have a short time, hopefully, for some questions. And then those that have time afterwards, there's some drinks and refreshments outside. So without taking up any more of your time, I'd invite Andrew to come up and start telling his story for us. Thank you, Andrew.
Thank you. Well, thank you very much for having me and for taking time out of a sunny evening that I'm sure there's some inviting beer gardens, but good to be with you. I'm actually going to talk about two companies. I hope that's okay. I didn't get sign off to do that, but just to contrast a little bit, two startups that I've been involved with. The first company I started in 2010 with two co-founders. It was a data and software company in the healthcare space in the US. I didn't go into that knowing much about entrepreneurism or hadn't really spent a lot of time thinking I would start a company. An opportunity came up. One of the co-founders is my closest friend, who I've known since I was 5 years old and is my son's godfather. And the other co-founder is another close friend of ours as well. So really a chance to work with these two guys and an idea that came along is how we got into it. As a result, I was pretty naive, I think, about a lot of what starting a company was like and how to get going and how to fundraise. We managed to raise a bit of money at the beginning. We raised about $750,000. Spent that as judiciously as we could, raised another round, and got really sort of tired of doing that. And so we decided that we would not raise any more money, and we bootstrapped it from there. We managed to get profitable in 2014. We had our death spreadsheet that we were just continually stretching out as far as we could go, and then we've grown out of profits and from that point onward. I think I got into it and learned initially from a couple of VCs that were involved, and I took their advice pretty wholesale. I don't think safe to say I was just imbibing what was told to me. And one of the things that was kind of a common mantra was that you build a company to exit or you build a lifestyle business, with the idea that a lifestyle business is for losers, and you really should just build a company for exit. And so that's what we did, and that's what we told ourselves. That's what we told our team. We're building this company to sell. We found out later that quite a few of our employees who were kind of similarly maybe naive in how all these things worked had lived for about a year or two with the impression that the whole company was going to lose their jobs when we sold, because exit meant we all leave and the company gets sold. Didn't really realize that was sort of an unintended consequence of the way we were talking about it. But we just went on with that way for a while. I think it took a few years until I realized that really wasn't why I started a company and what I was doing. I didn't feel like I was building something to sell. I also didn't feel like it was a lifestyle company. It's certainly not the lifestyle I would choose. and I've not seen a lot of founders of companies with lifestyles that I admire too much. But I built it because we got to work with my closest friend. We got to build something that we thought was a good opportunity and something that we would be proud of. I think as we got employees, then it started to be about like the opportunity that we could give to our employees. As we started to get customers and we got to know them, the type of product and service, we had quite deep relationships with our customers. The thing that motivated and drove us was that they thought we were offering them something really of value and that made their jobs better. And so after a couple of years, I realized like those two sort of paradigms weren't what we were doing. We were really trying to build something of value, and how it sold and what sales looked like was not really our priority. And so we build to build and carried on doing that. We've actually been doing that for 13 years now. The company's turnovers tens of millions, and we've got 150 employees, and we continue to build. Now, kind of an odd story to tell in an exit conversation, but in a sense, we have done a kind of exiting in that my role is definitely different than it was when we started. We have a leadership team. They're driving a lot of the vision day to day and growth day to day. We've got new shareholders in. We made room for them by giving them some of our shares, selling them some of our shares at time. And the shareholder is much more aligned with kind of the growth story. I think there will be further exits along the road. I think at some point in time, there may be another entity that a consolidated vision might take us further. Variety of reasons why further exit might happen. But that was, I guess, the first just sort of lesson to me in that experience was, I guess that my at least personal motivation was not about build to exit, but was about build for value. And that brings me on to the next story. So I started in another company and started kind of thinking about the idea in 2017 and then really got going in late 2018. And at this point in time, Habitat Energy, I was sort of taking all of what I felt like I'd learned from the previous experience. Company that I was really passionate about. The sector that we're in Habitat is energy trading around batteries. So it's really trying to bring flexibility to the energy systems and enable the whole kind of renewables transition. So it's a space that's really interesting to me. It's going through a massive transition. We felt like we had a really good long-term vision for what the company could do and how we could create value. We set up the company in terms of how we funded it, who our employees were, who was involved for really long term. Like I thought this is the last job I'll ever have, I hope, if it went well, and that we would just build and build and build. In 2021, so 3 years later, sold all the shares of the company and exited, which was not the plan. But the exiting in that case, I still put in air quotes. I work harder in this company than I ever have, and I'm still more sort of committed to its long-term vision than I probably ever have been. So I guess that one would be considered an exit, but I don't feel like I've exited. The previous one wouldn't be considered an exit, and in some sense I have. So I guess that's just the kind of experiences that I've had around this. I think I'll go into a little bit more detail, kind of how that story came about, but the sort of learning from me in that is that I think when I think about exit, the position that a founder holds as a shareholder, as a board member, and as an executive can be disentangled in terms of what those roles are, and then what exiting that we're talking about associated with them. But with Habitat Energy, we felt like we were onto a really good opportunity. I had two co-founders again. That's another lesson. Is I think 3 co-founders is a great way to start a company. It makes for a really good balance of not too many people, but a good challenge when you get stuck on things. But kind of digression there. But we started that company. We initially funded it ourselves. We then got some angel investors involved, people that we were sort of mentors in the industry and felt like would be along with us for the ride. And like I said, we set it up to grow for the long haul. The industry is going through massive transitions. We built a capability that has to do with algorithmic energy trading and optimization of batteries. So we're forecasting energy prices. We're using various types of machine learning techniques to do so, and optimization algorithms that take statistical probabilities of how the outcomes will happen and are deciding when to transact energy in different markets and when to dispatch batteries. And this can apply to other types of assets as well, but what the batteries do, what the capability does, is it allows the system to have more flexibility. And as we're moving to more and more renewables in the energy system, a lot of the flexibility that traditional thermal plants give the system is not there. A lot of intermittency comes from these types of renewables, and so batteries and these kind of capabilities allow that kind of flexibility. And we got sort of involved in the right time. I'd like to think that we sort of had an influence in the scale of investment and the timing of investment that started happening in batteries in the UK, and sort of pioneering sort of the approach that we're taking today. We wanted to take that further. We felt like we're sort of on the really early days of where that can go and where that industry is going to go. We had a vision of, like I said, of kind of longer term how this transition is going to happen and what a company like ours can play in that world. And we felt like the one thing that would most hold us back is if the co-founders tried to hold on to all of the shares, and if we tried to grow out of our profits, or we tried to sort of just incrementally fundraise. We felt like we could probably make a valuable business. Maybe that would be the most sort of like income maximizing to ourselves over time. But in terms of being able to like see that vision out of what we wanted to do with the company, that wasn't going to be the best approach. We wanted to enter some new markets. We wanted to expand the capability set. We got approached by a private equity firm, as was mentioned, who was interested in us entering the US with them. And that was originally a sort of an arm's length sort of transactional relationship that we had with them. And as we sort of entered into that and got going with it, we realized that we were pretty values aligned with them, strategically aligned with them, and we felt like we could really sort of accelerate that growth journey with them in a way that we couldn't do on our own. So that's what took us to the exit that we ended up achieving with that company, and like I said, we're now pressing on from there. I probably won't spend a lot of time unless you guys have questions later in terms of just the specifics of the transactions or the I guess the more sort of mechanical parts of what makes for a good exit. I think there's a lot of experts that are going to talk in later sessions around, how to set up for exits and think about metrics and business models that are attractive and what types of processes to run and these sorts of things. Those are certainly important. But I guess my personal experience was much more around, finding the thing that I was really like passionate and interested in, and what value that entity could create, and then letting the exit sort of follow from that rather than targeting towards it directly. So that's some of my experiences. I will probably leave it there for questions, unless you guys want me to start doing questions now, given that our other speakers not yet arrived.
Yes, we're still waiting for Matthew. I'm hoping that door is going to open any second and he's going to appear. But maybe Andrew, don't disappear, but maybe we can kick off with a few questions.
Yeah, please.
How do you keep your staff How do you keep your staff on board when you're exiting?
Yeah, so that's a great question. If I had fully exited, I think in our case that it wasn't hard to sell, the same kind of statements I'm communicating here, which is, there's a shareholder change. I'm not fully controlling the board and the shares. To some extent, that may be a bad thing to my employees. They may like my decision making in a board level and want me as a shareholder. But then again, it doesn't necessarily change the day-to-day for them if we're aligned with that shareholder, and I'm still involved day-to-day working with them. So I think our team sort of understood why we were selling and bought into the vision. We introduced them to the team at Quinbrook as well, and a lot of them have got to know them personally. It's a relatively small private equity firm, so no first name basis with a lot of the people there. And so it almost just feels like we've got a more expanded team, more expanded possibilities. I think a lot of our team is driven by similar motivations of like what impact can we have, And so the fact that that we're stepping up to a level of impact was attractive rather than, or at least that outweighed a little bit maybe of the fears.
Thank you, Andrew, for your sharing. My question is on what sort of challenges that comes with it when you mentioned your partners are very good friends of you. How do you balance the friendship between you two and the business? You may sometimes your opinion may differ, and how do you balance that?
Yeah, that's a great one. I got a lot of advice early on as well that you shouldn't really work with your friends. And there's probably some truth to that. Honestly, I find that co-founding a company there's sort of marriage relationship and then co-founding a company relationship, just in terms of the level of stresses that you go through together, decision making, time that you spend together, and conflict. And I think just as with your closest friendship relationships, you can ideally find ways to have trust and understand the motivations and then deal with that conflict in a sort of direct and healthy way. And I found I can do that better with the people that I know and trust and have that kind of history with as much as stranger. And frankly, two of the co-founders I didn't know as well prior to founding the company, and now they've through the process become, I'd call them friends first before co-founders.
Thank you.
Sorry, could you get the microphone?
Oh, sorry.
Yeah, were you able to sort of create competitive tension in the exit process to get the best sort of valuation?
A little bit. I don't think we maximized that. I can tell you we didn't get the biggest opportunity that was available to us by some distance. And again, because the priority of what we were valuing is this a group that we want to work with in the same kind of close relationship? Do we have the same kind of vision? Do we want to scale together? And so the priority was around that. Wanting to understand that we were making a smart decision, we kind of understood. So we did work with an investment bank advisor. We did have a few conversations with others that we had relationships with and had approached us just to kind of understand how others were thinking about the space. But we intentionally didn't set up a formal process because we thought that somewhat undermine the sort of trust we were building and plans that we were building together. So judgment call, and others would have done that differently, I'm sure.
I think we've probably got a couple more questions. Give Matthew another couple of minutes to get his breath back.
Yes. A question, the first company is healthcare, the second one is energy.
Yeah.
Quite a big jump there. So do you find it difficult to transit between these two businesses, or do you find actually lots of commonality across?
Yeah, both. I mean, before I did either of them, I was a management consultant for 10 years and across all sorts of industries. So I've sort of maybe been too comfortable jumping around industries already. But the organizing thread across it is software and data science. And in both cases, the companies are heavily technology in that regard. So that's the area I felt comfortable with. My background was more energy focused. So this space was where I had spent about a decade doing consulting work and working with energy companies. The healthcare was a bit more of a stretch in that regard. But I'm involved still with both companies, and it's amazing how many sort of analogous conversations I have in both places. And a lot of the conversations are much more about company building, leadership management type topics rather than the specifics of the industry. I have great co-founders and other people on our team who have complementary depth where I don't. I guess is maybe another way that's made that possible.
James, quick one.
You're saying that you've got sort of sectors for these. Okay, yes, there's healthcare, there's renewables, but it sounds like clearly they've both been very, very scalable businesses. Is that a conscious decision you made in the first place to look into something that would be long-term scalable?
Yeah, I think so. That's a good question. It's probably a bit of revisionist history to say just yes. In the first company, I know we were looking to to understand, before we got in, is this a big market? If the business model was what we thought it was and the customers were who we thought we were, both of which were a huge punt and we had no idea. If so, we could put on a slide, massive market. So we had some indication there, but I think to some extent, the US healthcare space is massive, and the type of technology that we were doing was applicable to a lot of different types of companies in that. I think for Habitat Energy, absolutely understood this was a scalable problem. At this point now, I'd had lots of years to think about this, and the co-founders had been industry veterans in this. So I think we felt comfortable. We knew this was a space that was, our point of view and the whole basis on which the company was premised was that this transition was happening. This is going to be a massive area of investment, and that the company had plenty of opportunity to grow and scale there.
Okay, thank you, Andrew. I think the mention of a massive US healthcare market goes nicely to
Good to meet you.
I'm sorry.
Not at all.
Matthew, how are you? Good to see you, Robert.
So Matthew's going to talk to us now about his company's exit via name listing. He's still involved though, and I'm sure he'll tell us about that. Probably at the end we'll maybe get some questions directed specifically to Matthew, and then if we have time, bring Andrew back as well and maybe have a conversation there. So.
Very good. Well, first of all, I'm really sorry that I'd originally said I'd be here for 5 o'clock, so there you are. So I'm way behind schedule. So I've come out of London, stuck on the trains. It's just one thing after another, and then the timing was perfect. So I hit the Oxford traffic just at the best time. So it was just one thing after another. Anyway, so my background is almost purely healthcare, biotech, medtech, diagnostics. I started my career in healthcare. Originally, I was auditing for Pricewaterhouse, Liverpool Health Authority. I started there. I then went to work for ICI. I was at ICI for 10 years, and then that became Zeneca. So I was at Zeneca for another 5, 6, 7 years. And towards the end of that process, I headed up biotech at AZ, or what became then AZ. And then in the last 20 years, roughly 20 years, I've probably had 8, 10 different CEO or chair roles of growing technology companies, and they all fall into the process of being very exciting, international, scalable technologies, but very often they're not really ready for commercialization or at the very beginning of commercialization. So they all require investment. So I tend to both put my investment in and others' investment in. We build them, and if they're strong, they make it to the stock market. Sometimes they don't. They come out early and they stay as a private business, and hopefully they'll be growing off the market privately and strongly. So I'm dominated by healthcare, medtech, biotech, raising investment, building, especially in the US. And usually in technologies that I try to associate with ones that I can see a breaking through, coming through. So I do a lot in the early years. I've not done as much in the last few years, 3 or 4 years in Oxford, but a lot here in Oxford. So Oxford Biosignals was one that I was heavily involved with. So we built that, and we ended up breaking that up and selling it to Rolls-Royce. Covance in the US, a big healthcare group there. And then the remaining part then went off to form part of Deep Blue and the group down in London. So that did very, very well for all of the various bits. And very often there is the plan that you have. There's perhaps 2 plans. There's a big investment return for an investor, but there's also a personal return for the individuals who put their own money in. And it's quite tricky getting all of that right, because the investors usually have to be paid out first, depending on where the process is. And the last people who get paid are often the owners. But that's the way of the world sometimes, unless the owner is a big holder, in which case you can often influence things a little bit better in your favour. So that's a bit of background. So everything from, the other one I did here in Oxford was the Fertility Partnership. That's become a very big, successful group. We started off with Oxford and Hammersmith fertility units, then we grew that, and then we became the #1 provider of fertility services here in the UK, and then became Europe. And so that's a good one. And again, some of the models of valuation are based on EBITDA, multipliers of EBIT, and so on. Some of them are not. Some of them are based on high-end technology build, really exciting models. A company's got a breakthrough, if it may be graphene or stem cells. And if the technology is rich enough, strong enough, and very well placed, people will pay a high multiple irrespective of the financials. So they come from lots of different mixes and positions. And yeah, over the years, I've tended to therefore try and find, in my own way, the ones that I think are most exciting coming through. And the one I'm dealing with at the moment is called Gen-Encode. It was actually, five of us bought two companies from a group called Ferra Pharmaceuticals, a pharmaceutical company based in Spain, who'd launched a statin polypill, a polypill if you're familiar with statins. They launched it in 2005-06. They invested heavily behind the genetics of cardiovascular disease, but because they were a pharma company, they didn't have the commercial skills to be able to take that company up. So they did a lot of the legwork, a lot of the development, and then 5 years ago we bought two companies, one called GenDiag, the other one called Ferra Encode, and we merged them to form Gen-Encode. So as Robert said earlier, in 2018 it was bootstrapped, as we say, or self-invested. So we as a group just funded it. In 2020, I drew down about just over 500,000, 700,000 from a small group of investors. And then the following year did with 3 million. And then in 2021, we did 17.5 million. And we're still working with that 17.5 million. But the markets have changed, and where we thought we had a good valuation, the market comes along and changes all that, and it drops in price. So whilst it's on the stock market, there's an awful lot of other things that barrage it and make life difficult. So it's not as straightforward as exit to market, job done. Far from it. It's more a case of exit to market, keep building, build. And when it's gone way beyond, where everybody believed it was 10 years ago, that's usually when I kind of step away. Usually bring a new management team in and then move away. So that's it. I mean, it's quite, the people I work with as well, funnily enough, the ones I work with are all they've been working with me for a long time. Very often in the sector, I'm working with people I've known for 20, 30 years. Because I've worked with them before and we know each other, you know what the process is. And it's not easy. It gets hard from time to time, especially when there's a fundraise and the markets are against you, or the investors are not happy with the valuation. And you have to be pragmatic and you have to be real about it. And you have to make, from time to time, pretty tough decisions. So yeah, that's what I do. But I'm very heavily involved on biotech, medtech, and healthcare in general, where I can be. Is that what you wanted me to say? I don't know what you. I mean, is that just an introduction?
Well, it's what everybody else wanted to hear.
So, because I wasn't. I didn't come with a plan or anything. So.
Yeah, no, I think it's interesting because the last event we had was very much about two founders coming out of Oxford University, building a business and selling it for a lot of money. That's quite a different. You're coming from a very different route here. The founders still involved in some of these businesses you are?
As far as possible. I mean, the best thing about a company is if you can keep the founder there and you can keep that continuity of knowledge base and skill set and all of the good things that got it to where it was when you joined it, that's a great thing. But very often things change. I mean, because especially when there's a lot of money moving around, you can find that the people in the early days want to then think about cashing in and taking shares out. But that's a good thing as well, because it means the other investors with deeper pockets can come along and pay them a good price for their equity, and they can step back a bit further. But you have to have built that skill and expertise, and it has to be mobile enough so that it's not with one or two or three people, so that if they exit, move away, the knowledge base goes with them. So there's a lot of second benching going on and building a team behind them so that knowledge is in place. And especially with the university. And the university is even a little bit more tricky, because you've got the university itself, you've then got the founders, you've then obviously got the investors who are coming with the university. So there's three groups there that have to be, and then you've got other investors who are perhaps more financial, who are bringing real capital. So mixing all that together, it's not an easy mix. So yeah, but I mean, for me, it's really important to keep the founders, if we can, part of the process until it gets strong enough to be self-standing and so on.
Do we have a microphone somewhere?
Thanks very much for your sharing. My question is a bit maybe not so related to Gen and Code, but so in all the years you have gone, you must have seen a lot of management people doing well to manage a company. What is the most important characteristic or personality that you would think would be good for the management of very early stage startups?
Well, first of all, you very often find, especially with the university, that it starts with someone's pet project, someone's real life's work, their research program, what they've done, part of their DPhil, and somebody said to them, listen, this is really interesting, you should go on and do it. So it starts there. Usually there is a commercial angle to it. And by that I mean, for me, the thing that drives me most is what the market is telling me. It may well be the best science, and it may well be Nobel-winning, prize-winning, fabulous science. But if the market don't want it, or the market aren't going to pay a good return for it, then it's not of commercial value in terms of, let's call it exits. Exit tends to be associated with investment and return. And if you can't see that return, then you've got to be very careful about the pet project that somebody's life works have gone into, which they believe is really valuable because they've worked their life on it. And so there's a little bit of that. But then usually what I get to see are the ones that have come through that. So you start to see ones with real value attached to them, and you think, this is really interesting. So the next thing is making sure that everything is as it seems, because often people will say, this is better than it actually is. And you think, what does that mean? What does that mean? Because a scientist, and very much the detail, especially here in Oxford, people can make a big, for example, it could be, we've discovered this particular compound, this particular protein, this inhibitor, whatever it may be, and we found it's knocking out this, so it's going to close down that pathway and it's going to cure cancer. And you say, that sounds great. It's got all of the hallmarks of something that's really interesting. So I spend a lot of time going through let's call it the due diligence of all of that detail to make sure that what is gold is gold. So I spend a lot of time doing that in the early days, because after that, if the foundations are solid and all of the work is really well constructed, the commercial bit, the gold is worth something in terms of commercial. So it's a bit easier, because very often it's not quite the way it should be, and it isn't really formed in the right way. And there you have more development, more technology input, more investment to get it to a point where it's become a commercial prospect. So the closer it is to that commercial prospect, in some ways a little bit easier it is for moving it into the market. So there's a lot in there anyway, but there's a lot of things.
Thank you.
Oh, I don't know if we have any online questions.
I guess what his question says, what are the key things that you look for within a business? So obviously you've got to check the gold is actually gold, but in terms of the business itself, when you're looking to make an acquisition,
People, number one.
Yeah.
People, you've got to trust them. You've got to know what they're doing is real. They've got to know their space well. So they're the kind of, again, key features. Trust, because at some point there's going to be investment coming or growth coming and financials coming, and you've got to know, because often all that glitters isn't gold, and people get carried away with that. So in an effort to try and clamber to it, they'll say things and do things that are not quite where you want to be. So trust, facts, evidence, lots on evidence, and getting it right so that we're confident about what we're doing. And then when we're confident, we invest because we're confident. And then because we've invested and we're confident, that generally leads to other things happening commercially, which means collaborations, licensing, sales, acquisition, whatever it may be, to build that. And then you're into a cycle then of a process that investors like, because this is proven. It's starting to work. We can see value starting to emerge from it. And that's the next key milestone. And then when you get a few more of those, then it becomes even more interesting, because the investors can say, not only is it proven, not only is it delivering, but it's actually delivering now in multiples. And then that's where it gets more exciting, so more investment can come. So you're always kind of trying to get to a point where the risk you're taking is supported by the return, and you know you're making it confidently. So it's a solid position.
I've got loads of questions. I'm going to overlap a little bit with that one that Matt just read out. With that due diligence package, this is always something that's really, really important for me. What is it that gives you confidence when you're in that seeing that due diligence package? What do you want to see in there? And coming from the flip side, what raises the red flags? What makes you want to run away screaming?
You want to see that the individual, you've gone to see something, whatever it may be, and your expectations are that whatever it is, say more on the Oxford side, let's say a piece of technology, is really well understood by the individual. You don't really want them thinking about the sales, you don't want them thinking about commerce, in some ways not investment either. What you want them to be good at is what they do well. Just get in there and get that box right and do it well. Because if we know you're doing it well, the other pieces are a little bit more movable and manageable and can be moved into place easier. I mean, as we all know, whether there are certain skills that you don't have, and that's one in this box. It's something that not everybody has, which makes it special. Finding investment, in some ways, yes, it's not easy to find, but it's not special. You can find it. But these are very unusual. Let's call it a unicorn, but it's something unusual that you don't often see. And that's what really I'm looking for. But I'm also looking for the individual who also doesn't realise that they're working with that and that they've got something special. Because most of the time I can see roughly where it will be in value, but I'm not sure that it's quite, is it all there? Because the other side to it is as well, it's not a short-term thing. You don't just invest and then magically it happens. Generally speaking, it's a 5 to 10 year program. Well, mine is, if you're working with different groups, VCs, private equity, and so on, I mean, there's different groups, high net worth. Everybody has a different time horizon, but realistically, especially in technology and healthcare, a 5 to 10 year horizon's about where I typically see that it is. And the more investment that you're putting in is generally because it's a little bit more mature. You're putting a smaller investment in if it's less, it's further away, and it's therefore more risk. So there's, again, lots of different dynamics to it to try and get it about right.
And you were saying also that you've got, with Gen-Encode, for example, you've gone through several rounds of funding on that. Is that something where, when you've made that initial buy into it, was that kind of eyes wide open? We know we're going to have to do additional rounds of fundraising, or was it, fingers crossed we'll make it and we'll give you an exit in 5, but it might be a bit longer?
Yeah, we knew that we would need to raise investment. So when I took in 2021, when we raised the 17.5, I'd said that was a 2-year investment. But what we didn't expect was that the markets in tech terms would start to come off. So what you then do is quickly adjust. So you think, well, okay, we've got 17.5 here, the market's coming off. What happens in 2 years? We might not have enough. So, okay, well, maybe we kind of reshape things. So you're then playing with the business plan, adjusting it down, making sure the burn in terms of cash is not as high as it was. And if the market continues to move further down, then be cautious of that, because we need to also maybe move further down as well, whilst at the same time trying to grow the company as best you can to meet the targets and the milestones that you've set out in the original business plan. So you're kind of juggling lots of balls then at that point. But you've got to be in a position at some point in 2 years plus, 3 years let's say, where when you come back, whether the markets are not there, and this is the price of playing on the stock markets, that you have something that fits in that box, that looks like gold, that's really well crafted, that people will invest in. And I'm always thinking about that. I've always got to be aware that I can go out, and even when the market's really difficult, I'll find something, because that's good, what we have. And obviously, the more investment that comes, the easier the process in terms of getting that really well crafted. And then because we now move into scope and expansion. So in the moment, we're just launching in the US. We've just set up and launched in Germany. UK NHS have just come on stream in the last few months. So bit by bit, the framework comes together. But we've had to rush, and we've had to change, and we've had to juggle things in a way that we didn't expect because the market shifted. So you have to be a bit nimble.
And Sorry, final one. With all of this, are you finding you've got a kind of, it sounds like you're repeating quite a lot of this, or bolting on a lot of stuff. Are you sort of developing a core team of people that you're using repeatedly with different businesses, or
It's not, yeah, I mean, there's a bit of it in terms of you go over things sometimes again, but it's each model is quite different. Each company is completely different. So there are some parameters that are the same, but very often. But you are running through when it comes to the investment side, that tends to be fairly well drilled.
Andrew, do you want to come back and join us? Maybe there's some questions we can share. I know I've got one, and it was prompted by something somebody asked me last week, and that was, how do you value a unicorn? So if you're a founder and you're very early stage, you've got a unicorn, something fabulously high tech, not generating anything yet. How do you value that? When you're trying to raise investment, what percentage of the shares do you sell for how much?
That's a tough question. I don't know if I can answer that in the abstract. I mean, in the specifics, in the specific instances where we were, I think we had a sense of what, even before you could point to P&L and multiples of revenue, multiples of EBITDA, and you're more focused on what is this capability worth. We certainly know how much money we need to do the plan that we want to do, and we know how much equity we're willing to part with, and that's where we probably start from and see how far we can get at that with try to solve those two pieces of the puzzle.
Mm-hmm.
Yeah, and you can get a measure of it, because if everything in the box is gold and you show someone what's in the box, they go, whoa, that's gold. I put a good value on that. And therefore you run that past a few people, and there you've got some benchmarking that you can do. And you sometimes from time to time you run it out and somebody says, I'm happy to pay 20 times the multiple of EBIT, whereas the market might be at 5 to 6 because of something, and you think, well, that's a really good value compared to maybe what the norm is. So you do have to kind of, and it's not touting it round. Very often, especially if it's a unicorn, people are coming to you because they know. So especially here in Oxford, the great thing is that there are pockets of really clever things that go on from time to time, and if they're well positioned, then they can always raise some investment behind them. But it's good if the word's on the street that this is looking very exciting, and that draws in the interest.
Question for both of you. If you've got a business that you could realistically sell or float on a stock exchange, do you have a general preference between those two options?
So I've not put a company on a stock exchange. So I don't know. I think it would really depend on what you're trying to accomplish with the company. I mean, to me, selling a company to, say, a strategic really depends. Again, going back to my point of view on this is sort of I'm pretty interested in the entity that I've founded, that I feel a lot of personal investment into. I want it to grow and thrive. And so if there's a strategic entity in which that's a natural home, and within that's going to grow and thrive, then I want to do that. If it's more a matter of this is a standalone entity and somehow accessing those capital markets is somehow beneficial to its growth, then I'd want to do that. Or I may just want to keep it private and continue to grow it that way. But
No, I agree. You're absolutely right. I think there's a personal side to it, and obviously if you're a founder and somebody comes along and says to you, we've got this investment and we'd like to, but we're more capital based and we'd like you to list this on the stock exchange. The things that again it comes down to who's running the ship, who's making that decision. The investors outside of maybe the founders will be thinking, we want to see it go to the stock market because it's got much more multiple, and it's got to do with the business model. It's not a case of just getting to the stock market. Some business models don't make it to the stock market because they're just not quite attractive enough. You've got to be able to show multiples of growth on the stock market as a tech stock, which are quite unusual. They're hyper growth, they're stellar growth. Whereas there's plenty of businesses that are fabulous businesses that don't go to the stock market, but they're a little bit less risky maybe, but solid returns. So, and if you're an owner of any of those, you've got to think carefully, what do I want as an owner? But also, what do I want for my technology and what I've really worked hard to deliver? So they are caught between this. They need the capital, which is why they entertain other people coming to invest. But I don't think it's an either or. It usually is down to the strength of the business model for me as to whether it goes to the stock market. And from a founder perspective, the multiples of advance that you get when you do move to the stock market, if it's that exciting, should go with it. So you'll enjoy the fact that it's gone to the stock market because it's a great return, great profile for everything that's been worked on. So a lot of kudos goes with it.
Any online questions?
So what is life like after a trade sale, and similarly an IPO from potentially a founder's point of view?
Yeah, after a trade sale, after 15 years of calling all the shots, it's definitely adjusting to a reality where all decision making is no longer my own. And therefore, if I'm going to be heavily involved as I am, being really well aligned with those who I've invited into that decision making is really important. So far, personal experiences, that's been really good, and the people that we chose to be involved with were what we thought they were, and we've continued to build that trust, and we've been able to do the accelerated growth that we hope to do. But it could easily not be that way.
Yeah. I think it's a lifestyle question, because some people will say, I've worked all my life to do that, and I feel that this is the reward that I can now enjoy, and maybe they hang their boots up on that. I tend to have not spent all my time doing one thing, so I've tended to then look for the next thing. So I've done it more on that way because I enjoy it. And also you work with the people you've worked with for the last 20, 30 years. So that's quite, I probably don't, I'm a little easier now than I was. It's you were kind of going all the time. So I try and take a little bit more time out to do the life things a bit more now than I used to when I was younger. But yeah, I think there's a lifestyle part to it as well. And enjoying life as best you can. But if you can do the two together, wonderful.
Okay, any more questions? Any last questions for us today? In that case, thank you very much, Andrew and Matthew, for coming, and
I'm so sorry for being late.
Dash to get here, but Andrew kept us all very well entertained in the meantime. So thank you to both of you. Just should mention that the next in this series is coming up in 2 weeks' time, 22nd of July. So if you've enjoyed this evening's event and the last one, if you haven't caught the last one, you can catch that online as well. But if you've enjoyed those, then please come along in 2 weeks' time when we have a speaker who is two speakers, in fact, from an M&A business this time. So looking at it from the other side of the fence, so the investor side of it, very much. Who I think probably will have something equally interesting to tell us, I hope. So please come along and sign up for that. And thank you very much again for coming.
Thank you.
Thank you.
Thank you.